Hello everyone, this is Dan Hussey with ElliotWaveForecast.com. I'm the host of the live trading room. That is from 11:30 a.m. Eastern Standard Time till 1:30 p.m. Eastern every single day. I wanted to do a quick video, quick tech blog here on the S&P 500. Now I know many of you maybe have seen this analysis before for me. I've put this out a number of times over the last few years because it's been accurate and it's still accurate. We're going to take a look at the monthly S&P 500, and I want to compare a fractal pattern of technicals and wave structure that has occurred prior in the market to what we're going through right now. Amazingly, the market actually went through a very similar situation one generation ago, about 40 years ago in the 1970s, and it's actually incredibly amazing how the market has effectively repeated exactly what it did 40 years ago. So let's go over this monthly chart that I have up. You see the big pullback in the 2001-2002 market, and then a rally to new all-time highs in the S&P 500, and then the pullback in the 2008-2009 recession. You can see it's a very clear A, B, C expanding flat structure. And then coming off of the 666 all-time lows, the market has rallied now to an all-time high, and it's done so with such vengeance against the bears that it's quite amazing that anyone is still a seller of the S&P, and has been the whole way up. Nevertheless, this expanding flat correction is amazingly also, if you draw from zero, effectively the beginning for the S&P 500, right? We're talking about all-time price action here. You draw from zero to all-time highs. The 50% line came in at about 800, and that is the area that got a bounce twice here in the S&P 500. So all-time price action pulled into a halfway back or 50% long. Amazing. The technical upside target for such a pullback is a 1950 or 1945 in the cash, 1950 in the futures. So it's a negative 23.6 line, and look, we are almost there. In a few short years, we have rallied the almost 1,000 points necessary, the 1,300 points to this target. Amazing. Another important technical that since the Great Depression has never crossed back over is the 50-month moving average, this red moving average, and the blue moving average here, the 200-month. They came very, very, very close in 2012 and the beginning of 2013 to crossing, putting in a death cross, but they did not. They bounced off each other. Just a few short years, mind you, after the all-time or the low here in 2009. The structure of rally, pullback, big rally is also in this market right now. I'll go over this in a second. So now let's look at what happened back in the 70s. And wouldn't you believe it? In 1974, we put in at that time, full halfway back long, drawn from zero to all-time highs in an expanding A, B, C wave flat. The 250-month moving averages came very close. Keep in mind, this is only 5 points away. That's about what they came in 2013. But keep in mind, it's also much bigger swings because of inflation. They came close to crossing, but never did, and bounced. And wouldn't you believe it, we had a rally, pullback, big rally up into the 145 upside targets from, at that time, the 63 all-time halfway back, 50% long. So we have identical wave structures in both the correction and the rally, as well as 250-month moving average bounces. That is an extremely important technical level, because if we go back all the way back to the Great Depression here, the last time they crossed was in 1930. They put in their death cross, and then they crossed back over in 1946, and since 1946, for the last 70 years, have never, the 50-month has never been below the 200-month moving average on the S&P 500. So full halfway back long trades goes to target, and then we have a next in series full halfway back that is the last major pullback or low before an inflationary rally, 2 through all-time highs, and one that just breaks the bank for bears. So I'm not saying we're looking for that full halfway back down to 1300, 1250 just yet, but at some point here in time, we are going to expect the market to effectively hit upside targets at the 1950s. We've come so close, why would it stop now? And this market could then give you a nice, much bigger pullback and a much larger cycle here starting in 2009, 2008. Effectively give you a setup that one last dip before inflation sets in, and 30, 40 years from now, we'll be talking about how the market moved from 600 to 1,000 range now to a 10,000. You just shift that decimal place over, and that's how inflation sets in every generation or so. So identical structures in both the pullback and the expanding flat, technicals bouncing, 50 full halfway back longs holding, and going to negative 23.6% targets. So we are looking for those 1950s to the upside in the short term. In the near term, we're very, very close, and at some point here, the S&P will end a major cycle, just not yet, guys. So I hope you guys have enjoyed this video. This is just some of the analysis that we do in the live trading room to augment the already great ElliotWave services at ElliotWaveForecast.com. With that being said, have a great day, everybody, and we'll be back with you as price action develops.